All right, let's get right into it. We're looking at G3 Apparel today, and their latest earnings report is, well, it's a real head scratcher. It's basically a story in three acts. You've got this awesome quarterly beat, then a huge guidance cut that tanks the outlook, and finally, this massive strategic pivot that could change everything for them. So the call kicks off on a really high note. You have the CEO, Morris Goldfarb, basically saying, hey, we crushed it. He announced that the company beat expectations on, both sales and earnings. And at that point, you're thinking, okay, this is going to be a nice, simple, positive earnings call. Spoiler alert, it was not that, not at all. So here's how we're going to break it all down. First, we'll look at those solid Q2 numbers. Then we'll get into this whole beat and lower paradox. After that, it's all about the headwinds. What's actually causing the trouble? We'll cover their big pivot to owned brands and then wrap it up with our rating and what you should be watching for next time around. All right, let's jump into part one, that earnings snapshot. And honestly, this was a surprising beat. I mean, considering how tough the retail world is right now, G3 really managed to pull off something that got everyone on Wall Street talking. So check this out. The first huge number is earnings per share. It came in at 25 cents. Now, to put that in perspective, the analysts, they were all penciling in something around maybe 9 to 11 cents. So this wasn't just a little beat. No, this was a massive 150% surprise. Just blew expectations out of the water. And it wasn't just on the bottom line either. The top line, net sales, also came in really strong. We're talking over $613 million. That's a solid $40 million more than what the market was calling for. Now, yeah, okay, it's important to note this was actually down about 5% year over year. But look, given the environment we're in, that is still a really, really solid performance. Okay, so you're probably thinking, wait a minute, if the quarter was so good, why did the stock get hammered in pre-market? And that is the million-dollar question. This brings us right to the heart of the matter, what we're calling the beat and lower paradox. And this is where it all gets weird. You've got this massive disconnect. On one side of the coin, you've got this fantastic Q2 beat that we just talked about. But then, on the other side, management drops a bomb, a huge reset to their full-year guidance. They're basically telling the market, don't get too excited, folks. The party's not going to last. Let's just look at the raw numbers here, because they tell the story. The guidance for the full year is, well, it's pretty bleak. They're guiding net sales down 5%. GAAP EPS, that's getting chopped from over $4 down to the mid $2 range. And adjusted EBITDA, that's getting slashed by almost 40%. It's a huge cut across the board. So you have to ask, what on earth is causing this dramatic nosedive? Well, that brings us to the two big culprits that management pointed to on the call. The first is a perfect storm of unexpected tariffs. And the second is a massive, massive transition in their business that's actually been in the works for years. So let's talk about these tariffs first, because this number is a big deal. G3 is looking at a total extra tariff bill of about $155 million this year. Now, they think they can offset some of that, but they expect to have to just eat 75 million of it. They just can't pass it on. They can't mitigate it. That is a direct, painful hit right to their bottom line. Now, don't get me wrong. They're not just sitting there taking it. They're trying to fight back. They're pushing their vendors to share the pain. They're shifting some production out of certain countries. And yeah, they're trying to raise prices here and there. But let's be real. In this kind of environment, with retailers being so cautious, these strategies can only do so much. And that still leaves that massive $75 million hole in their budget. Okay, the second big problem. This is the transition away from their huge PVH licenses. We're talking about brands like Calvin Klein and Tommy Hilfiger. At its peak, this was a $1.5 billion business for G3. $1.5 billion. But fast forward to fiscal 27, and it's projected to be just $400 million. Think about that. They have to replace over $1 billion in sales. That is a monumental task for any company. So, you've got tariffs crushing your margins and $1 billion hole blowing up your revenue. What do? What's the plan? Well, this brings us to their long game, their big strategy, a huge pivot towards the brands they actually own. And the strategy here is pretty simple, at least on paper. They're shifting their whole business model. The goal is to stop relying so much on these lower margin licensed brands and instead make their own higher margin brands the real engine of the company. I mean, it makes sense, right? When you own the brand, you control everything, the product, the marketing, and most importantly, you keep more of the profits. The good news is they're not starting from zero. Not by a long shot. They've got a really powerful portfolio of brands they own that are already showing some serious momentum. You've got DKNY, which is getting a huge boost from that Hailey Bieber campaign. Then there's Donna Karan, which is their top performer, and they're aiming to turn that into their next billion-dollar brand. Karl Lagerfeld is on fire in North America, with sales up over 30%. And even Vilebrequin is expanding beyond just swimwear into a whole lifestyle thing. So there are definitely bright spots. Now, trying to pull off a pivot this big, it costs a ton of money. You have to pour cash into marketing, into inventory, into stores. And this is where G3's fortress balance sheet, as they call it, really becomes their secret weapon. They're sitting on nearly $300 million in net cash, and they've paid down almost all their debt. That gives them the financial firepower to ride out this storm and actually fund this massive transformation for the long haul. Okay, let's pull all of this together. We've seen the good quarter, the really bad outlook, and the long-term plan to fix it. So, what does this all mean for an investor? How should we be looking at this company right now? And this really sets up the classic bull versus bear debate. The bulls, the optimists, are looking at the awesome growth in those owned brands. They see the potential in new licenses like Converse, and they love that clean balance sheet. They see a clear path to a much stronger, more profitable company down the road. But the bears, they're focused on the here and now. They see those crushing tariff costs, the huge risk in trying to replace $1 billion in sales, and a retail environment that's just shaky. So where do we come down on this? For us, the rating is market perform. Look, the long-term story is compelling. You can't deny the growth they're seeing in their owned brands. But those short-term problems, the tariffs, the PVH transition, they are just too big to ignore right now. It feels like, for the time being, the risks and the potential rewards are pretty evenly balanced. So when the next earnings call rolls around, here's what you should be keeping an eye on. First, gross margins. Are they making any headway against those tariffs? Second, what are they saying about the holiday season? That's going to be huge. Third, that owned brand growth rate. Is it still chugging along, or is it slowing down? And finally, what are they doing with all that cash? Are we going to see more share buybacks, or maybe even a strategic acquisition? And really, that's the question that sums it all up for G3 Apparel. Can this pivot to owned brands actually outrun the tariff storm? They are in a legitimate race against time. They have to grow their own brands fast enough to plug the holes left by the tariffs and that giant loss of PVH business. The next year or so is going to be absolutely critical in seeing who wins that race. And as always, just a quick reminder, this is not financial advice. Please be sure to do your own research before making any investment decisions.